afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 5th of January, and together with my co-host, Jeffery Halley, we have today Kelvin Wong, Senior Market Analyst at Oanda, as our guest today. Kelvin, good afternoon.
Hey, hi, good afternoon to you, Brian and Jeff, and Happy New Year to all.
And Happy New Year to you.
Kelvin, before we get your insights, Jeff, maybe you can take a look and tell us about how markets across the region have been performing.
Of course. Okay, over in Kuala Lumpur in Malaysia, the KLCI is up 0.45%. The Shanghai Composite is down 0.2%. And down in Australia, the ASX All Ordinaries is down 0.15%. However, in Japan, we are seeing a rally today. The Nikkei 225 is up 0.68%. Hong Kong is around just slightly lower at minus 0.1%. And in Korea, the Kospi is down 0.35%.
Now, Kelvin, what's your view on market performance in the first half of the day?
Well, if you look at the first half at this point in time, it's rather mixed, I would say. It's neither bullish nor bearish. Since that we only trading into the last, in the first 3 to 4 days of the start of the new year. So this is also primarily due to a lack of liquidity as well, as given the fact that most market participants are still yet to be in action.
Kelvin, let's take a look at currency markets for a moment. It's been a fairly tough week for the Australian and New Zealand dollars, the Australasians. They've been trading quite a lot lower over the week, and indeed that continued overnight as well, that weakness. Could you tell us what's driving that weakness and perhaps give us a quick technical outlook for both?
Yeah, sure. Maybe let us start with a bit of color first. What's driving this potential movement is due to, I would say it's more like the Aussie and the Kiwi has kind of a retreat from a kind of extreme overbought level. So if you look at their previous quarter performance, 3 months quarter performance, Q4 last year performance, they are up close to 5.8 to 5.4% against the dollar. So they are actually a pair of best performing currency other than the Swiss against the dollar. Of course, on the average, you look at the dollar index, the dollar just shed 4.5%, looking compare that as a benchmark. So for sure, and also do not forget over here is that at the start of this year, we start to see a kind of a profit, I would say a rather steep profit-taking activity in certain, we call it benchmark risk asset, which is the Nasdaq 100. So the Nasdaq 100 actually is down close to 4% to 5% at this moment in time since the start of the week. So that's actually also driving the Aussie and the Kiwi as well, because primarily the fact that both of the currency are considered as high beta currency. So in a nutshell, they do have a very strong direct correlation with the movement of risk asset classes. And given the fact that globally, the current, we call it the grandfather of risk asset right now is the Nasdaq 100.
Yeah, so Kelvin, then what's driving that underperformance and significant underperformance in the first half of the day?
So especially
the year, I mean this week, correct. In fact.
Precisely. So if you look at the situation over here is due to the fact, do not forget what causes the rally in risk assets. Let me talk about the Nasdaq 100, the rally in the Aussie, the rally in the Kiwi, that means i.e. the dollar weakness story in Q4. It's not a kind of a improvement or a clear improvement in economic growth, but rather the hope of better easing liquidity condition in the US, then thereafter spreading to the rest of the world. So why? Because do not forget, market participants right now are actually betting for a rather high optimistic dovish Fed pivot. But if you look at the Fed funds interest rate futures, they're looking at 6 interest rate cut. The first one coming in March this year. So initial pricing about 2 weeks ago, we're talking about 80% chance for the first pricing to come in. But after this week movement, it started to temper down slightly lower to 60%. Odds is still rather high. So what's interesting over here is that we also start to see a sell-off in bond prices. That means, i.e. Treasury yields, longer-term Treasury yields starts to tick up as well. So now hitting that psychological 4% level. So to me, that's actually kind of driving off the current risk-off scenario that is taking shape right now at the start of this year, and also causing that dollar weakness to be tempered off. So we start to see this kind of a pullback in Aussie and Kiwi strength. So talking about the technical picture, in the very short term, if I look at the Aussie dollar as per se, if you look at my chart at this point in time, for the Australian dollar at this point in time, is that what we could see over here is it will be more like a sideways movement to me. Now it's testing that 67 psychological level per dollar. So top side potentially could be capped at around 67.70. So I do expect a bit of sideways range trading into today, heading into that non-farm payroll data that's out later at 9:30 p.m. Singapore time.
Right, and here we are, the first Friday of the month, and of course it is the US non-farm payroll data out this evening. That's rolled around seemingly very quickly to me. We saw better than expected ADP employment numbers from the United States overnight, Kelvin. Does
Yes.
that point to a higher non-farm payrolls figure tonight potentially, or is this a fairly weak correlation?
Yeah, so if you look at the current situation in the historical past, ADP number has been pretty much erratic. I mean, in terms of direct correlation, it's rather weak. And especially, I do believe that last year they slightly tweaked their calculation for ADP side of the story. So that could actually further dampen the relationship with ADP numbers and the official non-farm payroll number. So I do believe that traders and market participants shouldn't be looking into too deep into that very strong ADP number being calculated yesterday. But what market participant concern over here is that right now, market is actually expecting about 170K increase for the month of December for NFP. That's below 199 increase in November, and also below that a rolling 12-month of average of 240K jobs added per month. So if you look at the last 3 or 4 months, number has been hovering between this 180 to 100 to 200K job increase per month. So that's kind of a neither too hot nor too cold kind of scenario for the US job market. So in some, it's a kind of a Goldilocks scenario. But we should be more concerned over here is that if you're on the very bullish camp of the story, that means i.e. for risk assets, if numbers start to show up to slightly above 200K for tonight, the numbers come in. So that will mean that i.e. the US job market is still rather hot. US job market rather hot. It's good for the economy, but it's bad for the market. So the market is forward looking. And do not forget the fact that, as we earlier discussed at the start of this show, this ongoing risk-on rally is driven by the fact of liquidity. That means hoping that the Fed will actually ease faster at a faster pace and easing come closer to the month of March. So if the numbers start to turn out rather relatively lukewarm or hot around about 200K or 220K increase, that dovish expectation could temper off. And do not forget over here is that in stock market US seasonality in the last 25 years, the month of February is a rather weak month. So that could actually kind of drag down this ongoing profit taking in Nasdaq 100 to spread across to the rest of the US stock market.
Now, on that note, Kelvin, thank you very much for your insights, and thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez.
And I'm Jeffery Halley.
And this interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.